Morning, everybody. It's August 18th, 2011. It's been a while since I posted a video, but this morning, there was a few things that prompted me to want to put a video out, and I really need to get back to doing more video. So, this morning, the significant event in my mind this morning was what's called a death cross of the S&P 500. This is a technical analysis term, and what it refers to is the 50-day exponential moving average or a simple moving average. I look at exponential moving averages. The 50-day exponential moving average moving under the S&P 500's 200-day exponential moving average. Basically what that means is weakness in whether it's the S&P 500 in this case or some other security. The moving averages are just really technical indicators that show health of a particular security or index. The last two times, and this doesn't happen that often where a 50-day goes under a 200-day moving average on a broad index. It doesn't happen as much as it would on a volatile stock or a volatile ETF like a small cap stock or a small cap stock fund. The S&P 500, the last two times we saw the 50-day move under the 200-day exponential moving average was back in the dot-com blow-up, in the beginning of the dot-com blow-up in the market, and in the most recent downturn in 2008, 2007, 2008 time period. And we know what's resulted from both of those. Now, I'm not saying that's going to happen again. It's likely that it could happen again, meaning a big drop once we see this, quote, the death cross. There's also a term called the golden cross where the reverse happens, where we saw gold crosses in the last two times we saw gold crosses was in the recovery periods from the dot-com blow-up in 2008, meaning market recovery periods. But the reason I say, one should pay attention to these death crosses on the S&P and the gold crosses, don't get me wrong, but what we're dealing with right now is a death cross on the S&P. The reason you want to pay attention to it is they don't happen that often, and when they do, what happens after usually is a pretty significant drop further in the stock market or in that index or particular security. So the point being is pay attention to this. This is something you definitely want to, if you are inclined, lighten up on equities if you haven't already. If you have already, it's played out well for you because obviously stocks have been weighing lower. The reality is I wouldn't be so concerned about this if there were strong fundamentals backing the economy, but we've got a weakening economy. We've got PMI reports all over the country from Philly Fed to Empire, Chicago, Richmond, Dallas, all weakening. ISM figures all weakening. We have unemployment still rising. We have significant debt problems around the globe. In my opinion, I don't think most people have any clue how bad the banking system is in Europe right now. You could literally see a Lehman-esque collapse of a bank in Europe. It wouldn't surprise me at any moment. You could see that. But the ECB, the European Central Bank, is doing their best to shore up the banking system. But I think in the end, something's got to give. Either the ECB is going to print money until they've gotten themselves into the position we're in the United States, which looks like is what they're going to do: bailout, 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 or they're going to let one of these things fail. Either way, it's a bad result. Just like in the United States, if they would have let the banks fail, we would have had serious turmoil in the markets. But taking that medicine earlier rather than later, would have been better. But in my opinion, we can see what the bailouts have done, which is really not a whole lot of anything. The stock market's risen, but now it's weakening. The Fed gave us QE1. We got a little more than a year of good performance in stocks. Things started to trail off. We got QE2. We got a shot in the arm for 8 months. Now stocks are weakening again. Do we want QE3? Do we want some type of Fed intervention? If we don't get it, we're going to get what should have happened in 2000 and 2008, which is a real big drop in the stock market, worse than what we saw. But the Fed's just, the central banks around the planet just don't want it to happen. Nobody wants it. I don't want it to happen, but the reality is you have to have a reset. It's just like a person that runs up too much credit. They don't want to file bankruptcy, but guess what? That's the best thing for them to do, because otherwise, they're toiling away forever, under a pile of debt. I mean, bankruptcy is not good on any level, but sometimes it's the best medicine. It might not taste good, but it's going to help. And it's the same thing now. The markets, just don't warrant being where they are. Even though they've come down, they need to go lower. So, I hate to be the wet blanket, but that's the reality. And there's a lot of data to support that. I mean, if you look at something like the Tobin-Q ratio, Tobin-Q ratio looks at the value of the market versus what it's really at, basically. There's with stock markets, you have what people think it's worth and what it's really worth, and the Q ratio measures that. And when the Q ratio gets too high, meaning people think it's worth this, but it's really worth that, usually, when it gets too high, it corrects down by the same amount. And we've seen that throughout history. But that interaction with the Q ratio ended in 2000 with the dot-com blow-up. We saw this huge rise, but the fall wasn't equal to the rise. And that's what history has shown back into 1900 with the Q ratio. So we didn't see that drop off then. We had the big run up, another run up from 2003 to 2008, and then we saw it again, a big fall off. But again, it didn't go as far as it should have. The Fed stepped in, the Fed lowered rates, Fed intervened. So the point being is, here we are again. We've seen stocks run up. We're seeing some of them pull back. The question is, will the Fed step in? If the Fed steps in and does more than just keeps interest rates lower till 2013, we're likely what we're likely to see is another goose in the stock market for a while. The first goose, QE1, was a year plus. QE2 was 8 months. What's not necessarily QE3, but whatever intervention comes next beyond lower interest rates, which clearly isn't going to get anything done. It hasn't done anything thus far. So whatever is next likely will give the stock market a bit of a goose for a while. But it's the reality is it's not going to last forever. At some point, things have to get back to where they're supposed to be. And supposed to be on the stock market is lower. It just, and I can, there's the person that's watching this saying, well, yeah, but look at corporate profits. And, corporate profits are only up for a multitude, but one huge reason, which is a devalued dollar, right? When you devalue the dollar, when you keep hammering that thing down, it increases exports. It helps companies. When you used to sell, in the hypothetical world, if you sold widget A for $1 and there was parity between, we'll say, the dollar and the euro, $1 is €1, and you sold, that's fine. When the dollar weakens, now your profits go up just because the dollar went down. You're producing in $1, selling it overseas, right, to a stronger currency. So the point is corporate profits have been booming because there's been a lot of layoffs. So a lot of companies are running thin, meaning labor costs are down. Labor costs are a big part of companies, and you have a weak dollar, exceedingly weak dollar, which really helps. So the point here is corporate profits aren't all what they seem. So the bottom line is watch the broad markets, watch your holdings. If you haven't lightened up on equities, I don't think you're going to be hurt here if you were to lighten up on equities, just because the fundamentals and the technicals in the market are all pointing to a weaker market, at least until there is some intervention. Again, I don't want it, but it will help stocks, that's for sure, because it has twice now. But just like a junkie with drugs, the more you do the drugs, the less impact you get on the high. You got to increase the amount of drugs you're taking to get the same high. It's the same thing here. The next round, if they did QE2 all over again, did another 600, we wouldn't see quite as much run in stocks because we've seen this story already. So that's it for this post. Good luck to you, and hope the markets treat you well.